That T word is once again on the tip of our tongues because today we're talking tariffs in our monthly market update from HighGround Dairy. Hear how tariffs are expected to impact dairy exports and some of our commodities that make their way across the ocean, like whey protein and non-fat dry milk, as well as the impact on our planting projections for corn and soybean crops in 2025. Hear all this today on the Uplevel Dairy Podcast.
This episode is brought to you by HighGround Dairy. HighGround Dairy provides global dairy market intelligence, insurance services, futures and options brokerage, and advisory programs to a diverse range of dairy market participants throughout the supply chain.
Information shared in this podcast is for educational purposes and is not a solicitation to buy or sell commodities. Opinions expressed are current as of April 16th, 12:30 p.m. Central Standard Time, and only represent the views of the speaker and not those of HighGround Dairy Trading unless otherwise expressly noted.
Curtis, welcome back to the Uplevel Dairy Podcast for our April monthly markets update from HighGround Dairy. And Curtis, what do you know today?
Yeah, so the big thing, and I guess the main triggering event that caused a lot of this craziness and market volatility was sort of the announcement from the Trump administration about the tariffs that we would be imposing. And a lot of them, I think the main justification is rooted in either a trade deficit or existing tariffs between the U.S. and other countries. I would say an objective to kind of even the scales. I think there's a lot of longer term benefits that we could debate all day about reshoring manufacturing industries into the U.S. and all the longer term benefits that are tied in with something like that. However, there is some potential short-term pain that is felt because it is a bit of a shot out there to say, hey, we're going to do this thing. So initially, we saw equity markets take a pretty big dive. I keep reminding people, do not look at your retirement account. Does not matter what's going on with them.
But there was that moment last week. There was that moment when it was a really good time to look.
Yeah, well, and I say buying the dip was a good thing. And if you were to hire the best Hollywood scriptwriters to write a Netflix series about what's going on in the economy, I don't even think they could have come up with what we've seen here over the last couple of weeks, because we had it where Trump even scripted it to us and said, hey, right now is a really good time to buy. And then all those tariffs that we had talked about with the exclusion of what's going on between the U.S. and China, they put on a 90-day pause, and immediately equity markets, within a couple hours of that tweet that he had sent out, were back up again. So I think the main thing to kind of take away from all this, and especially with thinking about running a dairy business and any business in an environment like this, we get sort of accustomed going into the year of, hey, there's a range of possibilities that I think, I'm okay with. And depending on the frequency of how often you tune into this podcast or you read into other market things, you kind of get your expectations of like, okay, are we going into a good time? Are we going into a bad time? How is this going to play out for me? How is this going to play out for my business? I think with what's going on and sort of the aggressive negotiating tactics that are being employed, again, maybe these do have some longer term benefits, but in the short run, in the next, let's call it 12 to 24 months, the range of possibilities of what can happen has just been expanded. And that makes me a little bit nervous of what can happen, what sort of industries are going to be impacted by things like this, because we're starting to see some of that play out a little bit with different retailers and different companies that are starting to already impose tariff surcharges because of what they are having to pay and what sort of things they're having to go on. Interesting kind of time to be tuning into everything that's going on here around the world.
And how's this affecting our dairy markets?
Yeah, so luckily, I would say to a certain extent, the dairy markets are not perfectly correlated with equities. So we did see some downward pressure on things, but you got to think of when you're looking at a milk check and trying to derive like what market forces are influencing the size of the milk check that I receive every month as a dairy producer. It's the four products. So we look at cheese, butter, dry whey, and non-fat dry milk as our four products. When looking at export reliance, because the greater the export reliance of an individual commodity, the larger at risk we are with all this trade tension that's taking place. From a cheese perspective and butter perspective, we export some product, but it's not super important in terms of the overall balance sheet. I mean, most of that is consumed domestically. On the other side of it, our milk powder, so our dry whey and our non-fat dry milk, we export a majority of that. So that is the concern, I would say, right now with where things stand, because there seems to be some negotiation taking place between the U.S. and Mexico, which is our primary trade partner, at least for non-fat dry milk, skim milk powder. That seems to be going decently well. So not any immediate concerns there, but this thing has been pivoting so quickly. The longer term and what we really have targeted in this kind of trade tensions thus far has been highly centered on what's going on with the U.S. and China. China has been a very large customer of U.S. whey products. So that's been an area of concern there, that we built all these new cheese plants that we've been talking about. We have all this additional processing capacity to make this whey. But now one of our big customers is pushing back on us and giving us some pretty significant hurdles in terms of where things stand right now. I think the retaliatory tariffs, as of recording of this podcast today, we're looking at about 150% on whey products out of the U.S. into China. So that creates some significant hurdles for us for moving products out of the U.S.
So with that question mark on China's ability to use up some of those whey proteins that we've invested a lot in as an industry, or I should say the processing side has invested a lot in. There's also, as we learned from Ted Jacoby a few months back, there's such a growing demand domestically for whey protein. Any gut read on, could the U.S. demand pick up to a point that it helps to just offset what could be a pullback from China on that specific dairy product?
We could certainly see that. Whenever looking at markets, it's always important to consider where the pressure is, but also the timeline of which the pressures are going to give way to some sort of a movement. And I think with this right now, because we know that there is an insatiable global demand for those high protein whey derivative products that are out there, we maybe have some limited access to certain markets because of these trade tensions that are taking place. But we also have a little bit of a lagging impact from, can we even meet some of that demand here domestically, because a lot of these plants that have been built or been expanded upon in the last 12 months or so, they are current state mostly manufacturing the commodity style dry whey. They're not climbing the value chain quite yet. So that's been weighing on that commodity value. It's kind of created this large basis between where commodity grade dry whey is trading in the cash markets and where the higher protein wheys are. So that's a bit of a challenge there. But again, I think only time will tell to really answer that question more specifically in terms of what pressures will give and what timelines will collide for giving us more clarity of that situation. But as for right now, as things stand today, we're potentially blocked out of a very large demand segment of how we may move that product. And we're manufacturing quite a bit of it. It's not a huge impact on the milk check. I mean, other solids value as it compares to butterfat and protein in the milk check is relatively small, I would say. But it is still something to make note of because it does help drive value.
Yeah, well, thank you for the update on that portion of what you're seeing in the dairy markets. What else are you keeping your eyes on right now?
Yeah, so, I mean, the big kind of question mark throughout all of this year has been related around milk production. Typically, when you look at dairy markets historically, when there is a period of time where dairy farmers are granted really, really good margins, we typically see a couple months later or about a year later, we see the milk come and we see that expectation kind of come to fruition of like, hey, when you incentivize people to make a lot of money milking cows, guess what? They're going to do more of it. And I think we've always joked about this, and the answer to market conditions is, yeah, make more milk. If prices are high, make more milk. If prices are low, make more milk.
It's the number one rule of dairy farming.
And I think historically it's like A plus B is equal C. And so we kind of make this assumption of like, hey, if there are good margins, we're going to see more milk. But there's been some structural challenges that dairy producers are faced with in this market cycle, which I would say is a little bit different than what we've seen in previous market cycles. I think a lot of it gravitates towards what we're seeing with the beef on dairy segment because of these record high beef prices. If you have the opportunity to ring that bell and sell a day-old calf for I mean, it's getting close to, if not over, depending on where you're at, over $1,000 a head for a day-old beef cross Angus Holstein. By all means, you should be capitalizing on that market as much as possible. That is a very, very good revenue stream. I tend to think of that whenever we're walking through some of the finances with some of our advisory clients of how are we managing this? How are we looking into some of these things? I tend to look at that and say, hey, these are essentially credits. Like whenever you cull cows or whenever you are able to capitalize on that beef revenue, that's essentially a credit to help reduce your cost of replacements. And historically, if you roll together the revenue that you make from culling cows as well as selling off like beef cross calves and stuff like that against the cost of bringing replacements into the herd, on a per hundredweight basis, you're still somewhere in that $1 to call it $2.50 per hundredweight of a net herd replacement cost of what it costs you to keep bringing those heifers back into the pipeline. But I think right now, when you run the numbers at where this beef market's at, if you're running a pretty reasonable cull rate and you have a healthy inventory of replacement animals, your cost of raising those animals versus the revenue being received from the beef crosses and the cull cows is pretty close to offsetting, if not offsetting, all of your replacement costs, which is a crazy thing to say out loud because we've always said this is a net herd replacement cost. And now it's almost like a net herd replacement line item that maybe it isn't even a cost anymore, as long as the inventories are managed properly and as long as your numbers are all correctly calibrated on that stuff.
Yeah, and it all goes back to knowing those numbers, right? That's what you and Paul had sat down and chatted about when we were in Central Plains. And for those that wanted to catch up on that conversation on looking at financial and management efficiency, that was one of our episodes that went out last week here on the podcast. And Curtis, what else is catching your eye lately? I know there's some things that you're looking at when it comes to planting projections for the 2025.
Yeah, so we're entering that season of the year where we've got estimates on planting projections. I know we had talked about this briefly last month, but USDA published the numbers of 95.3 million acres of corn is our targeted number. Pretty significant increase from where we were last year, almost 5 million additional acres of corn that's going to be added onto the balance sheet. The original USDA Ag Outlook form had 94 million acres. This was a slight bump up from that. What I think is interesting, though, when you think of that many acres that are going to potentially be put on the balance sheet, is right now, when they put out the original Ag Outlook Forum estimates of 94 million acres, they also tied to that a 181 bushel per acre yield. That would have resulted in a record crop. I think you also have to take into consideration if we're going to put all these extra fringe acres into corn because the bean situation isn't looking very good with all the trade tensions and how much of a reliance we're having on China with something like that. It's about 20% of our soybean crop every year domestically goes to China, so that's a pretty big hit if they're not in the picture for us. But yeah, from a corn perspective, I think if we have all those fringe acres going into corn, we have to kind of lower our expectation of what that yield's going to be. So that's something I think if a 181 is the trend line yield, I don't think we're going to get anywhere close to that, even if all the weather conditions are perfect over the next 2-3 months. So it's something that I think probably something in the mid 170s is a bit more reasonable to assume. We'll see what weather gives us. Like I said, we're entering that season right now in the next 30 days. Weather forecasts are going to move markets almost as much as tariffs will. So that's something that we're going to be watching pretty closely. We have seen over the last couple of weeks a good amount of support in the corn market, kind of climbing away from some of these low prices and futures. And I know there's been a lot of people scratching their heads at that, saying, hey, if we're going to plant 95 million acres of this stuff, how could we possibly be building support in a market like this? I also think you need to take into consideration that we have been exporting quite a bit of our corn crop to Mexico and Japan and other people that have been a bit more amicable when it comes to trade relations. So I know that's something for the current marketing year that we're in. The latest WASDE report that we got for this month, they actually upgraded that by 100 million bushels for our expected export. So that brought us down pretty significantly, almost 100 million bushels there on the ending stocks. So if we're working that ending stocks number lower because we're catching some of this export demand in the short run, that is going to keep tightening that balance sheet and kind of moving that up a little bit. Now, from a risk management, margin management perspective, this kind of creates, again, what you were saying earlier, if this expands the range of possibilities of, hey, if we're going to work out some of these export deals and we're going to keep moving a good amount of corn to Mexico, or we're going to have some weather issues, we could see a $5 corn market. That is a possibility, which is crazy to think that way with a 95 million acre crop. But everything has to go right to keep a lid on this thing here. So for some people that maybe don't have their core needs bought for the rest of this year, we've been looking into some flexible ways to step into coverage there, because we don't necessarily want to be bullish right now because of trade wars and because of all the other things like that. But having some flexible coverage in place so that if prices move up, we're not going to be putting ourselves in a situation financially where we're decimating our margin potential for the rest of this year. Those are good places to be. We're also looking at this, again, wide range of expectations. If you do have physical bought for the rest of this year, you're long your cash corn, you're in a good situation here. And we're looking at all these headlines saying, hey, this thing's giving us a little bit of a head fake. We think that there's going to be a bit of a reversal and we're going to push back towards the lows here within the next couple months as long as weather cooperates. Then again, we're looking at the futures market for some flexibility to say, hey, if we're doing good in our cash contracts, we should take advantage of some of this upward price momentum to tuck away some of these profits before these contracts expire. So again, this is where I think having that knowledge, having that know-how of how to use these markets to your advantage, especially when things get volatile, is so important, because no matter if you're bullish, if you're bearish, or whatever your stance is on things, when there's volatility that's playing and you have a position in the market, there's always something to be doing and something to be working.
Being able to have the ability to play in that space and take advantage of some of those market changes, especially if you have the opportunity to buy some of those inputs on the dairy side, hopefully be able to manage through with some good guidance any of the changes that could come about between now and the end of the year as we look at those markets. And Curtis, as we wrap up today, what else has been going on? Where are you spending your time when you're looking at how to best benefit dairy producers that you serve? And what should they be looking at in the next month ahead?
Lately, I've just been coaching through the noise of, hey, if you have positions on and markets are moving, there's always something that you could be doing. At the end of the day, when it comes to trading and risk management, there's only 3 possible decisions you can make. It's buy, sell, or do nothing. And I think a lot of people by default just say, well, we're just going to do nothing. But you have a position in this market, whether you like it or not, and being able to navigate that with some flexibility to take advantage of some of these moves, whether it's positive or negative, has been, I think, a huge value add to everybody's operations. I mean, you're looking at right now for the second quarter of this year, we're in a bit of a rough patch from a margin standpoint, whereas we've seen a lot of erosion there. For our clients that have been more proactive and are way ahead of this thing now, and we have unrealized gains, whether that's through insurance contracts or through futures contracts, we're looking at ways to protect that now because, hey, if we're catching a bid and this cash market for cheese is holding steady, we want to make sure that the advantage we had, the proactivity that we took in place in our plan, isn't going to go to waste because this thing's going to jump up and make a crazy move on us or anything like that. So we've been doing lots of coaching through that. It's a little bit more, I would say, some advanced calculations that go into that in terms of putting additional positions on to really hedge the hedge or put another layer to things here. But again, that's where I'm working with a professional that does this stuff full time and focuses on how to really capitalize in these markets and make the most of these moves. It's super beneficial, and we see the clients gain a lot of success from that.
So would you say strategy and agility are 2 of the best things to have support in right now?
Yeah, I think it's just knowing what lever to pull when markets make a big move. I mean, I think when equities were going crazy and everyone's checking their retirement accounts, freaking out, saying, oh, I should sell or I should do this, knowing what lever you can pull through either an options play or something like that to really get on top of this thing to capitalize from maybe the fear that another market participant's experiencing, that's where the pros really separate themselves from the amateurs in these markets.
Well, hey, we're glad that we have a pro that we get to tap into every month here with you, Curtis, when we sit down to do these market updates. And anything else that you'd like to share as we round out this market news for April?
I think we're in pretty good shape. I think right now, the main thing we keep just encouraging producers to do is continue to look at the rest of this year. Q2 may be a little bit of a rough spot, but there are still some good margins to work with for a majority of producers through the rest of this calendar year. But because the range of possibilities has been expanded with all the crazy headline risk that's been thrown at us, having some of that tucked away, having some security, being able to capitalize on what's out there before things potentially turn for the worse is always prudent. rule number one of risk management is stay out of these markets before they eat you alive.
Excellent. And Curtis, for anyone who's listening that'd like to get in touch with you and your colleagues at HighGround, or check out the link that you contribute to us every month for more information on market updates, make sure to check out that link in our show notes. And Curtis, thanks again for jumping in with us here on the Uplevel Dairy Podcast.
Yep. Thank you, Peggy.
You just heard from Curtis Bosma from HighGround Dairy here on the Uplevel Dairy Podcast. I'm your host, Peggy Coffeen, and until next time, keep on growing, keep on learning, and up-leveling your dairy.